What if I told you about a healthcare stock that recently posted a 40-cent per share net loss, took a brutal hit to its gross margins, and got hammered with an intense patent infringement lawsuit from one of the biggest pharmaceutical giants on the planet? You'd probably assume the stock was drowning in red ink. You might even bet it's a perfect target for short sellers. And you'd be dead right about the short sellers. But you'd be completely, jaw-droppingly wrong about the price. Because this exact same stock is up a staggering 45% in just the last 30 days. And that's why so many people are asking the same explosive question right now. Is HIMS stock about to erupt? And could a massive short squeeze be about to begin? Welcome to the confusing, high stakes, and deeply polarizing world of HIMS and HERS Health in the summer of 2026. Now, if you find breakdowns like this valuable, do me one quick favor and hit that like button and subscribe, because you will not want to miss where this story is heading. That sounds like an impossible contradiction, doesn't it? A company bleeding cash and fighting lawsuits, yet its stock is on fire. But everything starts to make sense the moment you look under the hood at what's really driving this extreme volatility. Right now, HIMS is trading at $35.15, riding a structural rebound that has completely eclipsed its earlier Q1 sell-off. So what is the market actually reacting to? A massive fundamental shift. This company isn't just clawing its way back from its earlier missteps. They are aggressively reinventing their entire business model and expanding across the globe at breakneck speed. In fact, they are quietly trying to become the Netflix of healthcare. But could getting there really be as smooth as the bulls hope? Not even close, because it's proving to be a wildly volatile ride. At first glance, this looks like a clean, straightforward comeback story. But the real catalyst behind it reveals something far more dramatic, a massively forced hand. Here's where it began. The rocket fuel for HIMS originally came from mass-marketing compounded semaglutide, essentially an off-brand version of Wegovy, for an eye-popping introductory rate of just $49 a month. It was a brilliant customer acquisition machine, until Novo Nordisk sued them for patent infringement, and the FDA and the Department of Justice started asking some very uncomfortable questions. So what did HIMS do? They pulled the plug. They halted all advertising for compounded versions and struck an official partnership with Novo Nordisk to distribute the real branded drug. And just like that, they immediately diffused their most severe legal risk. That sounds like a mature, stabilizing move, right? It is, until you realize just how much capital it takes to fund a pivot and a global expansion of this scale. To power this bold new vision, HIMS went on an absolutely massive liquidity run. They upsized a convertible debt offering to $350 million, and then locked down a $400 million receivables facility with JP Morgan Chase. But why on earth would they need nearly $750 million in fresh liquidity? Because they just bought Australian telehealth firm Eucalyptus for $1.15 billion. In one move, this hands them an instant footprint across the UK, Germany, and Japan, all while they simultaneously pour cash into their AI infrastructure. So they've got the cash, the global reach, and the branded drugs locked in. Sounds bulletproof, right? But before you get too bullish, there's a serious regulatory storm brewing right around the corner. Mark your calendars for July 23rd and 24th, 2026. The FDA's Pharmacy Compounding Advisory Committee is convening, and their staff is aggressively questioning the safety and clinical efficacy of 7 popular wellness peptides, with a specific target on one called BPC-157. And here's the kicker. HIMS recently acquired a dedicated peptide manufacturing facility, betting big on this as a massive future revenue stream. So what happens if the FDA drops the hammer and bans mass compounding of these peptides? That entire revenue vertical could vanish overnight. And that brings us to the one question every investor actually cares about. How is all of this chaos translating to the bottom line? The Q1 numbers are a fascinating mixed bag that tells a very specific story. Top-line revenue hit $608 million, which actually missed Wall Street's estimates. And more importantly, the pivot to branded drugs, combined with $33.5 million in restructuring charges, absolutely crushed their gross margins, dragging them down from 73% all the way to 65%. So why is the market so excited? Because here's the silver lining. Management raised their full-year revenue guidance to a massive $2.8 to $3.0 billion. When you combine shrinking margins with explosive revenue projections like that, the charts start doing something very, very interesting. Technically speaking, HIMS has built a definitively bullish structure. The stock recently broke out of a daily flag pattern on exceptionally high volume. It's now trading comfortably above both its 20-day moving average of $31.08 and its 50-day of $28.22. cents. But here's the catch. Is this momentum sustainable, or is it running too hot? The relative strength index recently pushed above 70, flashing a clear overbought warning. The charts are screaming momentum. But here's the strange part. If you ask the actual analysts who cover this stock, nobody, and I mean nobody, can agree on what it's really worth. Wall Street is completely and utterly divided. On the bearish side, Truist Securities slapped a $23 price target on HIMS, pointing directly at that steep FDA regulatory overhang. But on the bullish end, Canaccord Genuity sees accelerating sales and a successful GLP-1 transition, raising their target all the way to $40. And right in the middle sits Bank of America with a $37 target. But they offer a critical warning worth paying attention to. They see a severe threat to second-half profits due to churn risk, as patients suddenly realize their $39 introductory Wegovy rate jumps to a whopping $149. And this division isn't just showing up in the ratings. It's playing out with hundreds of millions of dollars swirling through the institutional flows. The smart money is locked in a high-stakes game of tug-of-war. On one side, Morgan Stanley aggressively boosted its position by 126%, and Defiance ETF scooped up over 7 million shares. But at the exact same time, Capital World investors fully liquidated a 14.3 million share position, and Goldman Sachs dumped 76% of their holdings. And here's what should really make you pause. Over the last 6 months, insiders have executed 20 sells and only one single buy, with the CFO and COO offloading roughly $6.6 million in stock. All of this institutional conflict has created a massive structural anomaly, one that is heavily distorting the very mechanics of this stock. This is where the story gets truly explosive. Right now, over 61 million shares of HIMS are sold short. Let that sink in. That is nearly 30% of the entire public float. This represents a colossal pool of trapped capital. So what happens if those short sellers get forced to buy back their shares to cover their losing bets? It would take them over 3 full days of average trading volume just to escape. And when you combine 30% short interest with what's brewing in the options market, you're staring at a literal powder keg. Take a look at the options chain, expiring on July 17th. There is heavy bullish speculation fiercely defending the current price. We're seeing a massive call wall sitting exactly at the $35 strike, holding over 11,000 contracts in open interest. There's secondary upside stacked at $40, while downside put support clusters at $30 and $35. In other words, $35 is the critical mechanical battleground for market makers right now. So what happens if the stock holds its ground just pennies above this battleground level? Could that be the spark that lights the whole thing up? If HIMS simply sustains its price action above $35, it could trigger a mechanical domino effect. Step 1. Options dealers are forced to hedge that massive call open interest by buying the underlying stock, pushing the price up. Step 2. That rising price then squeezes the 30% short float, forcing those shorts to panic buy shares to cover their positions. And here's the explosive part. This dual buying pressure compounds on itself, creating a propulsion target aimed straight at the $40 resistance level. And all of this leads us to a very specific, highly actionable trading window for the immediate week ahead. For short-term momentum traders, the setup between July 15th and July 18th is incredibly well defined. The entry zone sits right here, between $35.20 and $35.50, but only if we see confirmed volume sustaining above that options wall. The immediate target is the recent high of $39.05, followed by that major psychological resistance at $40. But discipline is absolutely everything here. A daily close below $34 breaks the entire technical flag structure and instantly invalidates this bullish thesis. That is your hard stop loss, no exceptions. But what if you aren't just hunting for a 4-day trade? What if you're trying to figure out whether this company is actually worth holding all the way into next year? If you're investing for the long haul, there are 3 critical metrics you simply cannot afford to ignore. First, watch the GLP-1 subscription churn rate in their August 10th earnings report. Because if patients start canceling their subscriptions the moment their price spikes from $39 to $149, their entire profitability projection could collapse. Second, keep your eyes locked on that FDA meeting on July 23rd. An outright ban on compounded wellness peptides would wipe out a massive future revenue stream in an instant. And third, they need to prove that their $1.15 billion acquisition of Eucalyptus can actually generate real international revenue without blowing up their debt-to-equity ratio. Which brings us to the final, unavoidable verdict on HIMS and HERS health. Before we get to that, a quick and important note. Everything in this video is for educational and informational purposes only. It is not financial advice, and I am not a licensed financial advisor. Investing in stocks carries real risk, including the potential loss of your capital. So always do your own research and consult a qualified professional before making any investment decisions. Now here's the bottom line. HIMS has engineered an undeniably impressive recovery. In the immediate short term, the technical breakout combined with that massive 30% short interest trap presents a highly lucrative, though extremely volatile long setup. But strategically, this stock is currently priced for absolute perfection in a deeply imperfect regulatory landscape. Until the FDA clears that regulatory overhang, and until management proves that their customers will actually tolerate a 280% price hike for weight loss drugs, long-term investors need to exercise extreme caution and strict risk management. The momentum is real, but make no mistake, so are the risks. So now I want to hear from you. If HIMS sustains above $35 through July 17th, do you think the short squeeze actually ignites? Or do you believe the FDA overhang caps this rally before it ever reaches $40? Drop your prediction in the comments below. I read every single one. And if this breakdown helped you see HIMS in a whole new light, smash that like button and subscribe so you never miss the next deep dive. I'll see you in the next one.